Good afternoon, ladies and gentlemen. On behalf of IMGC and cnbc TV 18, I welcome all of you to the first India Mortgage Leadership Conclave. Housing finance is a very key contributor to the economy. The housing industry is the second largest job creator. The Housing for All by 2022 is an important agenda item not just for the government, but all of us in this room. As a key stakeholder in the housing finance industry, we therefore thought there was value in getting a diverse set of participants in the industry within one room to catalyze thought leadership that could help us in the years to come as we get into a very crucial juncture in the industry. If you look around yourself, you will see senior leaders from the lending community comprising nearly 80% of India's housing finance origination today. If you look around yourself, you shall see statesmen from the regulatory world, both in banking and housing finance. If you look around yourself, you shall see people from senior development finance institutions who have flown in from all over the world to be here with us today. You will see people from the consulting fraternity, people from analyst firms, people from analytics companies, and we are quite delighted at the response this conclave has got that we are getting to you.
I have had the pleasure of working and living in a number of countries over my career, and that's exposed me to a bunch of different macroeconomic cycles, and of course housing booms, housing busts, financial crises, financial booms. It's been a bit of a ride, particularly over the last 10 to 15 years. Of course, the one crisis that I'll never forget is the Asian financial crisis, because that was the event that showed us all that even in rapidly developing countries with exactly the right demographic underpinning as well as perceived adequate oversights, that everything could go terribly wrong very quickly. In fact, it's not a coincidence that all those bad loans were originated in really, really good markets. Of course, the positive side with the Asian crisis is that the economy's recovered on the back of stronger policies and infrastructure, which all helped. Of course, 10 years later, we had a different type of crisis. We saw a global downturn on the back of poor underwriting discipline and poor constituent accountabilities. And this was in the well-developed, theretofore viewed as best practice U.S. housing market. So not only did that crisis hit developed markets in the Americas and Europe, but also hit emerging markets such as Mexico. And since then, we've seen other crises, housing crises, which are largely dependent on economic downturns. And what's amazing to me is that while a few individuals may have predicted this, the financial markets really did not predict this well at all, especially the timing. It's not to say that the financial services group and the financial services sector, they're fully equipped with mitigants for this type of thing. When you look at mitigants, there's a number of trade-offs. You can have all the policies and the guidelines in place that you want, but there's always a cost to that. And one of the most common risk mitigants we see around the world is that lending tends to get restricted to the wealthiest people in a country or within a municipality. The restrictions are broad, and they can vary from things like not investing in technology and the development of non-traditional lending channels to doing something very simple like tightening underwriting guidelines. And an example of that would just be capping loan-to-value ratios. But it's important to remember that these macro and micro-prudential mitigation measures reduce risk, but they can also reduce risk at large societal cost. And do things like force credit-worthy borrowers to wait years to get into homes or to turn to the gray market for alternative financing. And for those of us in housing finance, that means there's an excluded market and an opportunity that goes to waste. So our theme today is how do we manage housing risk in a way that can expand home ownership. And to me, it's exciting because expanding home ownership, when done correctly, is valuable both from the commercial and societal perspective. And as Mahesh mentioned, housing is a major component of any macroeconomic environment. And I think KPMG actually came out with the study that quoted that the job market around construction would be the largest in India, would be the largest segment in India by 2022. But the point, however, is about more than just wealth and jobs. It's about the basic wants and needs of the Indian population, and I think the government of India gets that and understands that because they've made it a priority. But it's not only an Indian desire. We've seen many effective policies around the world go into place from Australia to Canada to Hong Kong to Korea, all with very good results. In closing, this is really an opportune time for India. You have an economy that's one of the few growth engines globally, and I think that's very important. So with that basis, I welcome you with optimism.
Members of the finance fraternity, delegates to the conclave, ladies and gentlemen, it is my pleasure to be here with you. I find that the theme of the conclave, innovation and emerging opportunities, is very timely and apt. Housing is a very important driver of economic growth due to its backward and forward linkages with a large number of industries and creates huge job opportunities besides providing a very basic need to the populace. The government's initiatives such as Housing for All by 2022 and push for affordable housing has given a major boost to the housing activities. The central government has implemented various initiatives to address the supply and demand side constraints, which include infra status to affordable housing, tax holiday to affordable housing developers for 5 years, ECB in affordable housing, credit-linked subsidy to economically weaker sections, low-income and middle-income groups, setting up affordable housing fund, and two important structural reforms, that is GST and RERA. All this will result in major push to housing activities and a spurt in housing finance. This is a space which is fiercely contested by banks, NBFCs, and HFCs, which should sharpen competition and incentivize innovation. For example, those who can innovate to build alternate credit risk models for segments who can innovate, for segments not having adequate financial records based on behavioral data or other parameters, will have huge opportunities. In any case, innovation has to be an ongoing process to get competitive advantage as well as develop more customized and affordable products. But what I want to talk today about is from an institutional perspective. So let's look at the Indian economy, which has moved away from sunny days to one of some concern rather quickly. The inflation, which has trended down in the near term, has even risk of trending upwards due to domestic as well as the global factors. A combination of volatile oil prices, rising US interest rates, a stronger dollar, and the intensification of trade tensions have already led to market pressures and capital outflows in some emerging market economies, including India. Quite a few see financial stability risk if the pace of rupee depreciation continues. To add to our woes, we have the recent phenomenon of liquidity and credit crunch affecting particularly the NBFCs, HFCs, and the mutual fund industry due to the happenings in the IL and FS group. The consequences of liquidity deficit are far more serious than that of capital deficit. This is because capital, barring very exceptional situations, would deplete gradually, giving time for replenishment, whereas no single metric would ensure sufficiency of liquidity. It is to be watched simultaneously and on many fronts. So there seems to be a case for tighter liquidity management at financial institutions of any hue, whose stress has the potential to rattle the markets and create panic leading to liquidity and credit freeze. To my mind, the episode has thrown up some difficult questions which need to be debated and settled. I would sum up by saying, never waste a crisis. Thank you for inviting me for this conference.
I think we are meeting to discuss mortgage finance at perhaps its most interesting time, maybe challenging time, since its inception, perhaps in the late 80s, when the first mortgage finance company, HDFC, started off. First, of course, let me start with the current issue, the most current issue of assets and liability, the match and the mismatch. Let me start with someone who has been here, done that. Shanti, the first question really is, how challenging is this asset liability management issue? Do we need to write new rules?
So let's just go back to the basic product. A mortgage is a 15, 20, 25, 30. I'm saying this because these are the tenors that are available in the market today. The 15, 20, 25, 30-year product are being funded by 1 week, 60 days, 6 months, 1 year, 2-year money. So just for anybody who's simple understand simple mathematics. There is an asset and there is a liability mismatch. Now, two factors are very critical. A, India needs lots more mortgage finance and lots more players. Second, there's enough demand. Supply-demand factors are very different. But if we do not resolve the availability of long-term pools of capital, we would probably be faced with the very situation we are faced now, again and again and again. So now let's go and see what are the long-term pools of capital available. PF, pension, life insurance. Let's look at the PF and the pension sector. They are largely funds that are used to fund the government and their various schemes. So the allocation that can be given to, let's say, long-term funding for mortgage needs is small. Insurance, they have their various schemes that they have to invest in, but insurance is another pool. And you have NHB. If you look at the percentage funding from, let's say, somebody like NHB out of the total mortgage market of some 16.7 lakh crores, it's a very small percentage. Between banks and mutual funds, they funded 10 lakh crores to the industry.
Yeah.
So I think there's a serious need to find long-term pools of capital. We could have FPI. There are many suggestions I have, but I'll rest to say urgent need of the hour.
Okay. Thanks, Shanti, for kind of setting the ball rolling. Since the person sitting next to you the parent company is the insurance company. So let me come to you, Mr. Vinay. Would you say that the first rule that needs to be written is perhaps reorganize or create a mortgage bank, convert NHB into a mortgage bank, so that it is able to float something like an NHAI bond, in some way attract household savings, retail savings, and thereby find 10-year money, 15-year money for housing finance? Is that the first thing that we need to do if we want to use this crisis?
See, the need is to have a 10-year, 15-year, 20-year instrument. From wherever it comes, that's immaterial. You either form a mortgage bank or convert NHB.
Do we need
the need is to have that kind of an instrument right now. We currently, the market is so tight on long-term instruments that is contributing to the liquidity crunch.
Let me come to you, Mr. Mishra. How do we look to solve this very genuine problem of source of long-term liability?
No, I would tend to agree with what Mr. Shah said, that, globally, if you look at it, insurance companies tend to be a source of long-term funding, but a lot of it tends to go towards infrastructure. As far as housing finance is concerned, I still believe a big challenge has been that there have been a spate of new players with varying ambition on scale, and therefore, I think nobody has really so far looked to fine-tune the financing part of it as much as the origination and the growth aspiration that they have. And in the bid to meet the growth aspiration, frankly, it's not really mattered if there have been periods of mismatch,
yes,
because nobody has really seen stuff like what we have seen in the last 3 to 4 weeks happen. We all believe that good times are here never to end, and therefore, I think in the ambition to grow, most people have kind of got the basics of the mix wrong. How much of funding they get from banks, how much to pick up from short-term money, how much to pick up from other sources. I think the whole mismatch has happened because people have wanted to show growth, because the nature of housing finance companies has changed. Many of them have private equity money, many of them have other forms of investors, and therefore, I think that has caused this mismatch, that the first priority has been growth. Everything else was meant to follow, and there were meant to be no bad
This is the first time we're facing this problem. So, we have to look for solutions only now. Any thought occurs to you, Ashwini?
First of all, I'll also like to clarify the side of how housing finance companies see their ALM. Some of them, of course, have a better ALM than others. But overall, if you look at the asset side, while it's a 15, 20, 30-year product, last 40-year history shows that the monies in a home loan come back in 6 to 7 years. So it's not really that we need 15, 20, 30-year funding to match on the asset side. Second, on the long-term availability of funds, I think the most matched structure globally is securitization. And India does not have a dedicated institution on the securitization like Freddie Mae or Freddie Mac existed in US, or a covered bond market like it exists in most of the European market. So that I think is one aspect, that if you have to be future ready, there has to be a good securitization market. We discuss floating rate government bonds, floating rate corporate bonds, or those kind of markets need to develop for there to be stability to the market. On the asset side, the entire mortgage industry, 95% of it is floating rate. So a product of a floating rate, securitization, and insurance and pension fund money, I think we are good to go with these things in place.
Can I advance this topic a little ahead? And you said floating rate bonds. It's taking a while, especially floating rate corporate bonds. What other ideas can we give? My sense is that if the regulators sat together with the government, maybe something like a long-term bond floated by NHB. We were speaking to IFC and they were interested. So, something like that could perhaps be a starting point to clear the current problem. Any other ideas? A REIT, maybe a REIT-like structure?
No, completely. And you mentioned about the NHB bond, mortgage tax-free bonds can be raised so that you build a mortgage market, because housing is the need. The government is driving housing for all. We need to provide roti, kapda and makan to our population. And if you have to provide that makan, you have to build instruments which is long-term in nature. I think one of the ideas is we should look at how NHB plays an important role in terms of raising bonds, which is tax-free, which is only created for a mortgage or a housing business.
We even now find that people prefer assignment of loans to securitization. That's because of capital and tax. So what's the way forward to make that part future ready?
The ideal thing is to pool assets, securitize it, and distribute it widely. Today, long-term capital is just restricted, like I said, to the insurance companies and the pension funds, and they're limited. Now, when you securitize a pool of assets, while they are still less risky assets, if you were to, let's say, people in this room subscribe to the bonds, they don't want to take the credit risk because they don't understand. But you need much more robust credit enhancement mechanisms. You need such institutions whose primary job was credit enhancing pools. So the buyer is buying a credit enhanced pool. Today, we don't have such kind of active institutions for credit enhancement for distributing pool. Otherwise, we will just be left with limited pools, and thus it's a problem. In addition to the markets, I think we also need to take away the physicality of a mortgage. I keep saying, going through title documents, it's so physical. If we can digitize a lot of this, then trading in the secondary market also, a lot of things become robust.
We could go on with that, but I'll take the cue and go to another future-ready issue that we have to handle, digitization. Rakesh, take it away.
So if we have to be future ready, we have to provide the entire customer experience, which is online, digital for a customer. And for that to happen, the land records and all title search which we do should be available online. There are states who have really progressed well, like Karnataka, Tamil Nadu and all. They have done Andhra Pradesh has done quite well on this front. But a lot other states needs to do, because I think it's across 29 states which we do business. But as a housing finance company, wherever it's possible, we should try and provide online and digital journey for our customers.
Exactly. I know, Ms. Mishra, you want to speak. I'll tell you, the problem with digitizing, we would like everything would be digitized. But in India, we still want that physical agreement. And that is why, as a customer, I don't want a digital loan. Because if I have to give my agreement, I want to know the guy I have to catch if I want that agreement back. So, Mr. Mishra, what's the journey from here to there to have a fully digitized loan? And where does mortgage guarantee come? Yes. Because that should be an important piece for digitization.
I think digitization, especially for the multi-product lenders, is still an area of focus largely on the unsecured side. You will meet a lot of people who say, I've got this cutting-edge analytics for my durables business. I've got this really credible score that helps me predict credit card spends. But when it comes to mortgage, you will typically see that the level of activity on digitization is lower. Now, part of it will happen because of things that Rakesh has said. But a lot of the things will happen in sequence and not happen, in parallelly and not in sequence. And I think when they happen, the lenders need to be ready, and at the current level of focus, that may be a gap. If you look at the US and you look at the top 20 lenders in the US, only 7 are the traditional banks. The remaining 13 are people like Quicken, which none of us outside of the US have even heard of, who are digital players who have ensured that with speed and pricing and digitization, and all of them came in and capitalized on the financial crisis when banks were distracted. So typically when you have a situation where banks and traditional lenders are distracted, overnight you will see an aggregator coming and becoming the largest player. I think we are underestimating how quickly digitization will descend upon us in the mortgage space. And I would really urge the lending community to go forward.
It was an engaging conversation, a great starting point, and I think many ideas are born here. Let's hope some of them will be taken forward. Thank you very much, Jen.